Hello there. Today, we're going to pull back the curtain on something really fascinating, a topic put together by the experts over at My Tax Accountant. We're going to break down exactly how some of the UK's wealthiest people can legally, and I mean legally, pay little to no income tax. And you know, it's not some single magic trick. It's actually a really clever, multi-layered strategy.
So let's kick things off with a question that I'm sure has crossed your mind. How on earth can someone making millions of pounds a year end up paying less income tax than their own employees? I mean, it just sounds, well, it sounds wrong, doesn't it? But believe it or not, it's totally possible, and it all comes down to some very, very smart and completely legal planning.
And really, this number is what it's all about. 45%. That is the UK's additional rate of income tax. You see, for anyone earning a high income, that's the big problem to solve. Think about it. For every pound you earn above the threshold, almost half of it goes straight to HMRC. So you can see why there's such a huge incentive to find a different way, right?
Okay, so here's how we're going to unpack all of this. We'll start with the core idea, the corporate shield strategy. Then we'll look at some government-backed schemes that can really slash those tax bills. We'll also touch on how pensions can be used as a business tool, which is a really clever one. And we'll wrap up with some advanced tactics for preserving wealth and see how it all fits together. Ready? Let's get started.
Okay, first up, the corporate shield strategy. This is really the foundation of everything we're going to talk about. The absolute first step, and the most important one, is to get your wealth out of your personal name and into a company structure. Honestly, just doing that one thing changes the entire game. It's like putting up a massive shield between your money and that hefty 45% personal tax rate.
So how do you do that? Well, the main tool for the job is something called a family investment company, or an FIC. The best way to picture it is like a private limited company for your family. But instead of, say, selling widgets, its only purpose is to hold and manage the family's investments. And by doing that, you create this much more tax-friendly space for your wealth to grow.
And this is where it gets really powerful. Look at the difference here. If you, as an individual, get dividends from your investments, you could be paying tax at nearly 40%. But if those exact same dividends are paid into your family investment company instead, the tax on them is, well, it's zero. Yep, in most cases, it's totally exempt from corporation tax. Just think about that. Your money can grow so much faster because it's not being chipped away by taxes every year.
But it gets even smarter inside the FIC. This is where you use something called alphabet shares. Now, this catches a lot of people out, but it's brilliant. You can create different classes of shares, A shares, B shares, C shares, you get the idea. And this lets you control exactly who gets paid dividends. So the founder, who's in that 45% tax band, might hold Class A shares and take almost nothing, but their spouse could hold Class B shares and receive just enough dividends to use up their tax-free allowance. It's about being incredibly precise.
So my tip here is pretty clear. Always use alphabet shares in a family investment company. It lets you direct the flow of money with surgical precision, always finding the most tax-efficient path. You're basically making sure the wealth flows to the family members with the lowest tax rates first. It's just smart.
Right. Next up, government-backed tax reducers. Now, if the IFCA is the shield protecting your wealth, think of these schemes as the engine, the powerhouse that can actively erase your tax bill.
You see, the government is really keen for people to invest in new, small, high-risk UK businesses. So to encourage that, they've created some really powerful incentives. We're talking about things like the Enterprise Investment Scheme, or EIS, the Seed Enterprise Investment Scheme, or SEIS, and Venture Capital Trusts, VCTs. Now, yeah, they can be risky investments, for sure, but for someone with a big tax bill, they are also incredibly powerful tools for reducing it.
And just how powerful are they? Well, this number says it all. 30%. If you invest in an EIS or a VCT, you get an immediate 30% income tax credit. And let's be clear, this isn't just a deduction from your income. This is a direct pound-for-pound reduction of your actual tax bill. It's a huge deal.
So for an individual with a high income, these schemes can reduce their net tax bill to zero. Let's walk through that. Say your income tax bill for the year is £300,000. If you were to invest $1 million into EIS companies, you get a 30% tax credit, which is $300,000. That credit wipes out your tax bill completely. It's gone. Your tax liability becomes zero. It's an incredibly effective strategy.
Okay, next section, pensions as a business tool. Now, stay with me on this one, because this next point is something that affects nearly every small business owner in the UK. We tend to think of pensions as just money locked away for retirement, right? But for smart business owners, they can be so much more than that.
Let's break down this SSAS loan-back strategy. So first, your company makes a contribution into a special type of pension called a SAS. That payment reduces your company's corporation tax. Good start. Then, that money grows inside the pension completely free of income and capital gains tax. Even better. But here is the genius part. The pension can then lend up to 50% of its value back to your business. So your company gets a loan for cash flow, and when it repays that loan, the interest payments go back into your own pension. It's this incredible self-contained tax-efficient funding loop.
All right, let's move on to advanced wealth preservation tactics. And you'll definitely want to hear this part, because this is where we get into the really sophisticated stuff. And it's all built around one simple core idea. And that idea is this. The central goal is to convert highly taxed income into lower tax capital gains. Simple as that. Look, income you get from a salary is hammered with up to 45% tax. But the profit you make when an asset grows in value, a capital gain, is taxed at a much, much lower rate. So the whole game becomes about making that switch. And this chart just lays it all out, doesn't it? You've got income tax way up here around 45%. Then you've got capital gains tax much lower at around 24%. And in some cases, with things like business asset disposal relief, it can go as low as 10%. So, for example, instead of a huge salary, an executive might get growth shares. All the value they create is then realized as a capital gain, not income. They've just swapped a 45% tax rate for a 10% one. It's a no-brainer.
Okay, but what if you need cash to live on, but you don't want to sell anything and trigger any tax? Well, that leads us to the ultimate strategy, often called buy, borrow, die. It's actually quite simple. You don't sell your assets. Instead, you go to a bank and borrow money against them at a very low interest rate. That loan gives you tax-free cash to spend, and all the while, your original investments are still sitting there, hopefully growing in value. You get the cash flow without the tax bill.
So let's talk about your strategic architecture. We've looked at all these different layers, the corporate shield, the tax reducers, the pension tricks. How does it all actually come together to get that tax bill down to zero?
Well, the key thing to understand is that it's not one thing, it's an integrated system. You start by sheltering your assets in a company so they can grow tax-free. If you do have any personal income tax to pay, use those government schemes like EIS to wipe it out. Use a SAS pension to pull profits out of your business tax efficiently. You make sure you're paid in capital growth, not income. And when you need cash, you borrow, you don't sell. Every single one of these is a legitimate tool. It's the way they're all layered together that creates such a powerful result. So it leaves you with a pretty big question, doesn't it? Could a strategic approach to your own finances completely change your future? Because what we've seen is that these kinds of results, they don't just happen by chance. They're the outcome of very careful, very deliberate planning. And of course, this level of strategy really does need expert guidance to make sure it's all done correctly and legally. Now, I do need to be really clear about something. Everything we've talked about today is for general guidance only. It is definitely not financial or tax advice. The tax rules are incredibly complex. They change all the time. So please, before you take any action, you must speak to a qualified professional for advice that's built specifically for you. And if you'd like to explore how these ideas might work for your own situation, the team at My Tax Accountant, who put all this information together, would be the perfect people to talk to. You can give them a call on 0208-570-8531 or just drop them an email at info@mytaxaccountant.co.uk. And finally, for more fantastic insights just like this, please do subscribe to the My Tax Accounting YouTube channel. Thanks so much for joining me today.